Thanks for joining us today on Market Call. I'm Morella Fernandez. Ryan Bushell on the show with us today. He's CEO and portfolio manager at Newhaven Asset Management. He'll take your questions on Canadian dividend stocks. Here's how to reach us, 1-855-326-6266. If you want to dial in, you can send an email with your question as well. Marketcall at bnnbloomberg.ca. Ryan, thanks for coming in.
Thanks for having us.
So we had another loss so far on the day. The TSX is down about 350 points. A record high close on Wednesday. What's driving investment these days?
Well, in the TSX, it's largely gold right now is driving the bus. I did a chart for our quarterly review, and gold is the only sector outperforming the index this year. So all 10 other sectors, it's materials. Obviously, gold's part of the materials sector, but of the 11 sectors, it's the only one that's outperforming. It's outperforming by so much that it's raised the average above everything else. So that tells you what's driving things. We are in some sort of changing of the world order. We have the U.S. government taking positions in private companies. We have a trade war that's ongoing and escalating, de-escalating by the day with China, depending on how the market moves. And so there's a lot of that that's filtering into gold. We're kind of bystanders in this. We own a little bit, but we're not big gold investors. And under the surface, actually, the infrastructure stocks we own are doing pretty well. So we're happy with where things stand.
Would you think gold has more room to run? Because as you mentioned, things do seem to be upending wherever you look. As you mentioned, not only politics, but AI seems to be making over everything that we look at.
You know, it's interesting as well, too. I've been watching the dichotomy between gold and Bitcoin, right? So Bitcoin's supposed to be the digital gold, supposed to be better in terms of the fact that it's more portable. The last guest that was on was talking about the cost of storage and the physical premium between actual bullion and the paper price, and then the miners and how is the best way to own it, whereas Bitcoin is fully digital and you can move it anywhere you want. There's no cost to store. But it's not performing the same way gold is. So that's quite interesting to me. In a
What does that say to you?
It says to me that the adoption isn't quite there yet. And it also says to me that the kind of man on the street test or person on the street test is being passed by gold right now. It is on the tip of people's tongue. So that to me is always a warning sign of bubble-like behavior at least. But the changes we're seeing kind of under the surface with the US Treasury market and China and Russia and the European Union and a whole bunch of the JGB, it's hard to tell where anything should be valued. I've been saying this for some time, is that assets are valued relative to each other, and gold was clearly undervalued relative to other assets a year ago, and is now, that's changed. So we'll see where it goes going forward. I think you can make an argument for it to go much higher. I also think you can make a very logical argument that we're probably overheated here and due for a pullback.
Okay, we are going to take a quick break. We will line up some phone calls and some emails for Ryan Bushell of Newhaven Asset Management, taking your questions today on Canadian dividend stocks. We're back in a moment. Welcome back to Market Call. Ryan's with us today to take your questions. We'll start with an email from Elma. She says, is Cineplex worth keeping? If not, what can I switch it for? Cineplex, of course, a struggling entity with showing movies. However, it did just divest of its digital media part of the business to an American firm. Or is there going to be much of a benefit from that, you think?
So I think Cineplex, this is a funny company for us, but I remember looking at it during the 08-09 recession, and it obviously had a great run off of that. And it's been a really well-managed company, actually. I really give a lot of credit to the management team. Obviously, and we thought, the next time that we get a chance to buy this thing, we want to buy this. This is a good kind of forever type stock, because those are the kinds of stocks that we're trying to own for clients. But by the time it did come back around, you have to question whether something is durable and will keep on going as it's going, or if things have changed. And clearly with Netflix and premium video on demand and just the changing scape of Hollywood and movies generally, it wasn't the same company when we looked to buy it in 2018, 2019, and we passed on it. Now I think the company's done a good job of managing through a very difficult time, but I think it's kind of steady state. I think the things like these divestitures. There might be some more hidden assets they can surface. There was a real estate, using their real estate assets more effectively as well, like the plazas that they're in. But I'm just not sure what the next move is for the company. So I would be kind of looking to get out of it here and move on. What to move to, it really depends what's in your portfolio and what you're looking to offset it with. But we still like the infrastructure companies, energy infrastructure companies. I'll talk about some of them in my top picks, so I won't step on that.
Sure, because trying to get into some of the other entertainment or streaming companies is not the same.
Yeah, no, exactly. And it's just an area people like it, that's fine. That's what makes a market. We just don't find it to be durable enough for our clients. I spoke to a client today. She's retiring at the end of the year, has worked 30 years for the same company. This is not someone who, is retiring with a massive, portfolio, but it's enough for her to live off of. But what I said to her is, you're 58 years old. We're going to take this to 98. That's 40 years. We need something that's very durable that can last that length of time, produce income for you to spend, protect your downside, and give you some upside if there is, worries about inflation or currency debasement, which is why the gold conversation we had earlier, right? So we're looking for those types of businesses. So we don't think that Cineplex is that. We don't think that the entertainment world just moves too fast for us, and that's fine. Other people will buy it and sell it and do different things. It's just not what we want.
Okay, let's go to our first caller then. Mike is on the line in Toronto. Hi, Mike.
Hi, I'd like to ask about Cabot Linen. It had a massive spike on their last earnings and has pulled back since. Do you think it's a good entry point around here, or would you wait to have it pull back a little further?
Okay, so I think we're going to talk about Cabot Linen a little bit later in the show, but generally, is it a stock that you like?
Yes, it is. Yeah. So, and that's why we're going to talk about it later. So, hint, hint. But the reason it moved on the last earnings call, they did an acquisition earlier in the year. There was an equity issue. It kind of pushed the price of the stock down temporarily. It's a small company and it's a pretty sleepy company. They don't do a lot of equity issues. They don't do a lot of acquisitions. And this was a pretty major one. So there was an overhang on the stock for a while, which is very normal. And then the last quarter was good. And I think investors saw sort of the early signs that their core business is doing well and the acquisition they did should do well. We had a good conversation with management, and I'll talk a bit more about that later. But yeah, it is a stock we like at the present time.
Okay, let's move on to Daniel, who's calling from Markham with a question. Hi, Daniel.
Hi, Marilla. Hi, Ryan. Great host and great guests.
Thank you.
And may I have your thoughts on Tamarack Valley? Do you prefer larger cap companies to smaller cap? And do you see smaller cap companies outperforming the larger caps? Thanks for taking my call.
Okay, thank you for the question. So Tamarack.
So that's a really good question. We do prefer the larger cap. Again, going to that safety, durability, that's what I'm going to talk a lot about today in a market that is potentially, certainly frothy in certain areas. So we're trying to see through that froth to what is durable and what is lasting. So I think if you're looking for smaller caps to outperform, you're going to want the commodity working for you. And right now the commodity is working against you. So, but interestingly, the whole Canadian energy space has been pretty resilient in the face of this commodity downturn. We've got crude back below $60. Typically when that happens, energy stocks sell off. I think investors are taking I think a lot of the more temporary money has been moved out of the Canadian energy space. And I think gradually we're seeing people return to Canada on the basis that we have lower decline rates, better prospects for transporting our oil out of the country, and a government that might be more supportive of further investment for the first time in quite some time.
Decades, yes.
So I think that is helping to buoy some of these companies, including like a Tamarack Valley that would normally be down pretty hard when commodity prices come down as they have. Like gas has been weak and oil's been weak. So I'm not sure. We like the larger caps just to have that safety and durability and a little bit more dividend yield in on average. But I think there's a good case to be made that oil prices could rally from here. What I think you're going to want to really watch in 2026 is drilling plans for U.S. shale drillers, and we'll see what happens with capital budgets with the commodity price now at budgeting time being low. Potentially those budgets are pretty subdued, and there are still high decline rates in the U.S. So if we're not drilling, that means oil production in the U.S. is coming off, and that could set the stage for a pretty good environment. Yeah.
Okay. Let's get in one last caller for this block. Ray is on the line from Pickering, Ontario. Hi, Ray.
Oh, hello. Thanks for taking my call. Brian, I bought Fortis on the dip back in April, and it's just been kind of range-bound ever since. And I'm just wondering why this, hasn't popped with, all the talk about powering data centers and such things like that, AI possibly as well. I'm just wondering why it's just kind of flat and if I should continue to hold it just to collect the dividend, I guess.
Okay, thank you for the question. We've got Fortis up now. It's at 72.26, down a little bit on the day and up 17% over the last year. What's your take on Fortis?
Yeah, I guess it depends on your expectations. I mean, I look at if you bought it on the dip in April around $65, you got $7 of capital, which is about 10+%. Plus, you're going to get your 4%, 3 to 4% dividend yield with 3 to 4% dividend growth on that. That makes us pretty happy. So we're happy to own a company that puts up, high single digits to low double digit returns sustainably every year. You talk about that durability. There's not many companies more durable than Fortis. It's got Canada's longest consecutive dividend increase track record I think it's over 50 years now, but it might be it's right around 50 years that they've increased the dividend every single year. They have a lot of growth ahead of them, but it's not going to be 20% a year. It's going to be 3 or 4% extra a year on top of their normal 3 or 4%. So if we're getting 8 to 10 in a stock that can do 8 to 10 we'd rather have 8 to 10 for 20 years than 20% for 3 years, and then who knows what happens, right? So we like that durability, we like that stability, and Fortis is at an all-time high. So again, in the market where it just kind of shows what the expectations are out there, right? People are looking for bigger pops, bigger moves. 17% year over year moving Fortis is pretty darn good for a regulated utility in my view.
They're kind of getting into the AI moves as well as some of the other energy movers that are benefiting from AI as well. So we will take a quick break. We're going to be back with Ryan Bushell of Newhaven Asset Management. Again, he's taking your questions on Canadian dividend stocks. Back in a moment. Welcome back to Market Call, and thanks for joining us. Dimitri's on the line. He's in Markham, Ontario. He's got a question today for Ryan. Hi, Dimitri.
Hi, Morella. Thanks for taking my call. Ryan, can you give me your thoughts, please, on Topaz Energy? I have already some large-cap energy stocks. I'm looking at Topaz for a long-term dividend payer, please. Thank you.
Okay, Topaz looks like at $24.50 today. It had a high of something close to 27, I think. No, 29.51, which was last year. What is your take on Topaz?
Yeah, so again, the energy space in Canada is much more stable in this commodity price environment than I would have expected. I guess maybe it's just past traumas that inflict that kind of expectation. But Topaz just did another deal with Tourmaline. They're very tied to Tourmaline, not only to Tourmaline, but mostly in terms of their assets, the royalties they get from those assets, plus the infrastructure that processes Tourmaline's gas. We like gas processing. We like royalty assets. We don't own Topaz. We own other companies that have a similar exposure, just not that concentrated exposure to one company. I quite like it. I think it's well run. I think both Tourmaline and Topaz are well run. Tourmaline is reducing their stake in Topaz over time, so that will allow the company to have sort of more of a free float out there and become a larger cap company as well, and that should help trading liquidity, but that's a double-edged sword because trading liquidity can go both ways. So I don't have any problem with it. Don't own it, but and at today's prices, I think we're kind of in the middle of the road. I'd be looking for maybe a little more downside before adding, and I wouldn't be trimming it here either.
Okay, thank you for that. Let's move on to our next caller. Nazar's on the line in Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Ryan. May I have your thoughts on Brookfield Infrastructure Partners, please? I heard your remarks earlier. You like infrastructure companies. This company pays a good dividend. Do you see growth with the expectation of government spending? Thanks for taking my call.
Okay, thank you for the question.
So the short answer is yes to pretty much everything the caller said. We own it. We like it. We like the dividend policy. We like Brookfield's ability to continue to source deals for them to do, and also divestitures. It's well run, lots of opportunity for them, infrastructure to support both energy and data centers, and also a good diverse base of infrastructure businesses across the world that do different things. So it's had a nice pop here recently. One thing I always recommend is to buy the unit structure in a registered account. You're getting the same company with a higher yield. The spread has blown out between the unit structure, the .UN structure, and the corp structure because institutional investors are chasing both Brookfield Infrastructure and Brookfield Renewable at the present time. And I think eventually there's probably a chance that that structure gets harmonized, and the unit structure should see upside from that. So if you can own it in a registered account, not worry about the taxable impact of the dividends, and you're getting more yield for the same company. So why wouldn't you do that? All
right, good advice. Let's move on to Sean, who's calling from Sarnia. Hi, Sean.
Hi there. Just your thoughts on Tourmaline. It's down over 10% since the beginning of the year. Would you continue to hold, and what are your expectations for it going forward? Thanks.
Okay, so Tourmaline, a natural gas player, yes, and we've seen the price of natural gas sort of come off a little. I guess a lot of people thought they'd start seeing upsides from the ability to ship now out to the West Coast, out to Asia, and that hasn't materialized. So do you want to explain a bit about why?
Yeah, so it's a really good point, and the AECO market, meaning the Alberta gas price market, the regional hub, because gas is priced very regionally, right? It is priced where it's produced. There are other ways, and Tourmaline's actually been very good at this, about getting gas to other price hubs and realizing better prices on that. But largely, the Alberta market has not played out the way that people, including myself, would have expected this year. But the reason is that storage was really filled up ahead of this, right? So people were ready for these trains to come on, and that was always the question: is, we're still only 3 or 4 months into the startup, and so it will take some time for that storage glut to be kind of pulled down, for things to normalize. I saw some stats today that the tanker loadings they were starting sort of 7, 8, 9, 10 days in terms of like tanker arriving
departing,
and then departing. Yeah.
Okay.
And we're down to 4 days consistently now for the past 3 tankers that have come in and out. So
what plays into that? Is that sort of how long it takes to fill up, or is that
just
something?
The efficiency of the plant, how well it's running, how it's a whole new, docking the boat. Everything is being done in real time. It's a new facility, brand new facility. So that bodes well, actually, though, that now we've seen very consistent results now for a few weeks. And so, we'll see how that goes going forward. Train 2 is scheduled to start up here as we go forward. So this is coming. It's just not coming maybe as fast as the market would like to see it, right away. And you turn the switch on and we're going. These are massive facilities with billions of dollars of capital expenditure. Like I said, an all new environment, facility, everything. So it'll take some time, but I think we're going to get there. And so stocks like Tourmaline, ARC, which we own, should start to see some lift from that. But it's a longer term structural play here. I wouldn't be too worried about any month.
So it's not a problem of lack of demand?
Don't think so. No, I actually think if we start actually building some stuff in this country, the demand could surprise to the upside. But, we'll see. We'll believe that when it happens.
Okay, let's get in another caller here. Jacob is on the line from Toronto. Hi, Jacob.
Hello, good afternoon to you. And I just would like to know about Suncor, if it's going to be picking up a little bit, or it's going to be dormant for a while, and if the gentleman owns it. Thank you very much, and have a nice weekend.
Okay, so Suncor involved in an acquisition as well. It's at 54.14 today. Not much up over 1 year. What's playing into them? Obviously, we talked about energy and prices being flat or moving down. What else is happening with Suncor?
Yeah, I think you've seen some rotation in the big Canadian integrated. So that's Cenovus, Suncor, Imperial Oil, and then to a lesser extent Canadian Natural. They're not integrated with refining as much as the other 3, but they kind of are in that large cap Canadian space. And so you've just seen attention focused otherwhere. IMO's been the big performer this year. It had underperformed. They're almost getting like the Canadian banks in a way, where it's sort of like one performs and the money moves there, and then the other one performs and the money moves there, because they're less idiosyncratic in terms of their operations. They're getting more the same, I would say, over time. Absent the Cenovus deal, which has also been taking a lot of headlines and and investor appetite in terms of their pursuit of MEG and the sort of toing and froing with that deal. So, I think there's just been some money that's come out of it. Plus, the commodity price has been weak, so Suncor has weakened with the commodity price, and those stocks tend to be more correlated directly with the commodity price because their larger cap and their cost structure is pretty well known. So it's not as much on the individual exploration upside or something like that. So, I don't think there's any concern. We don't own it. We own Canadian Natural. We think it's a better company, but I don't really have. Suncor's been very well managed. Rich Kruger's done a great job since he's been in there. Safety record's gotten much better. We like the assets at CNQ a little better.
Okay. All right, we're going to take a quick break. When we come back, Ryan will have a look at the past picks and see how they did. We're back in just a moment. Welcome back, and thanks for joining us. We are going to have a look at Ryan's past picks from November 12th of 2024, so just under a year ago. At the time, he picked BCE, which was at the time $38.60, now to $33.22. The company's been through a lot in that 1 year time, 14% drop return, 6% total return drop. BCE, we remind people, as always, is the parent company of this channel under the Bell Media umbrella. Dividend cut, trying to move over to AI and sort of building part of that division. A year ago, if you remember, what did you like about the BCE pick?
Yeah, so the company had come off and there was a lot of worries about a dividend cut, and we were pretty resolute that they could sell the MLSE assets and repair the balance sheet.
Which they did, yes.
And they sold the MLSE assets and they bought Ziply, and that really ticked some people off and then led to the dividend cut. And so here we are. I did not think it could go quite this low. Like if you look at the price it's at today, it's basically where it was pre-Teachers pursuing
it was
them.
double this, yes.
And they've built out a lot more fiber optic, wireless. They have a lot more assets than they did then. So I look at it as still a pretty asset-rich company. The dividend's now been reset. Management is now circling the wagons. They had their investor day. I believe that was this week. It's been a long short
It was,
week.
yes.
And lo and behold, you've got a few brokers coming out and upgrading the stock now. After it has bounced off 29 to 34, so it's already up pretty significantly. So we're happy to own this company. We think it's again, when you think about durability, we don't think the need for telecommunications is going away. We think that if anything, fiber optic data networks are going to have increased value going forward. And so, I think it's just sort of a matter of time as they churn through this weaker period, and big companies go through this sometimes, and you come out the other side and then everybody's like, oh, look at all the cost cutting they've done, and look how good the company's performing, and everybody gets back on the boat. So we're happy to buy it down here when nobody wants it, and we'll see if there's another day for it 3, 4, 5 years down the road.
Okay, let's move on to your next past pick from November of last year. Northland Power, NPI in the TSX, recommended at $20.12 a year ago, now up to $24.77. So 23% upside, a total return of 29%. Northland Power operates both in Canada and the U.S. Is this a stock you've held on to?
So not really in the U.S., more so globally. So more so Europe, and they've got a project they're building in Taiwan right now. So we still own this company. We like it. It's been actually a pretty good year for renewable stocks. If you look at Northland Power and Brookfield Renewable, they're both up significantly year over year. You wouldn't have thought that with Trump coming in. And,
exactly.
I think there was some worries kind of front end loaded on that the stocks, there was a bit of a shoot first, ask questions later. But for this company specifically, they're bringing on projects over the next couple of years. I mentioned the one in Taiwan. There's also one in the Baltic Sea offshore Poland.
These are wind turbines.
Offshore wind projects. They're substantially complete, receiving pre-completion revenues, which helps to de-risk the project. And so as those come on, the cash flow starts to come in and people put it in their models and they go, hey, this thing's worth more than it was a few months ago. Whereas we were kind of looking at it going, this is a company that's done a good job building things. That's what they're good at. The hard part they've had is some of the stuff they've acquired, but when they're actually building stuff, they're good at it. And so we had faith that they would be able to deliver these projects, and it appears that they are.
Got it. Okay, let's get to your third pick from last year. An energy company, Canadian Natural Resources, CNQ on the TSX, 47.07 at the time, down to 42.25 today. 10% drop, 5% total return drop. Are you riding this through with CNQ based on sort of oil prices being down?
Oh, yeah. I mean, again, this is a company that we're going to own for, I don't see us ever selling it. I think that it's just, one, it's really well managed. Two, they have really good assets. So it's going to ebb and flow with the commodity price, but they've increased their dividend. I think, I want to say it's like 20 straight years now, which is remarkable from an oil company with no cuts. And so that's what we like to see. We like to see a management team that's focused on shareholders. They just did a big acquisition of the rest of the Alberta Oil Sands project that they already owned. That is set to come through. And that will, again, just increase the free cash flow more. And I actually do see a pretty positive mid to long-term setup for the commodity as well. So, yeah, like it. Don't have any problem with it, buying it for clients today and tomorrow and probably for the foreseeable future at these prices.
Still putting money in. Got it.
Yep.
Let's take a quick break. We're going to be back with Ryan Bushell of Newhaven Asset Management with your questions on Canadian dividend stocks. We're back in a moment. Stay tuned. Welcome back. Thanks for joining us today. Let's go right to the phone lines. Ken has been holding on the line in Kitchener, Ontario. Hi, Ken.
Good afternoon. My question today is in regard to Freehold Royalties. It pays a nice dividend of around 8%. And I know, Ryan, your thoughts of oil is that it's probably going to go up. And I'd just like your thoughts going forward with this stock. Thank you.
Okay, Freehold Royalties.
Yeah, thanks. And I will clarify, there could be some short-term weakness in the oil price here. Never say never, trade war, economic concerns, et cetera. But the medium to longer term setup is looking good. So we do like this company. We own it. We like the dividend yield. You're not going to really expect much more than that unless you see a commodity price move, especially with commodity prices now back below $60. So I think it's kind of steady state. But again, I'm surprised at actually how resilient it's been during this oil price sell-off. Freehold's actually performed quite defensively, which is how it should perform. It's more defensive than an average oil stock because doesn't have capex, and the royalties are pretty consistent, and the dividend should support the company. So we're happy to see that happening, and we're happy owners going forward. So I think if you're looking to accumulate oil and gas stocks, we haven't really gotten that big opportunity yet. They're looking attractive especially on a relative basis, but we haven't seen that kind of flush. So if you're holding some cash back to buy some, I don't mind that. But we're happy owners. We're not sellers at these levels.
What would you consider a buying opportunity for you then?
I think like we looked at the Suncor chart earlier. So Freehold's off from maybe mid 14s to mid 13s. If it got down to that $12 level where it got to during the tariff craze for Freehold. And so you're looking for sort of that 10, 15, 20% downside.
Okay. Let's go to our next caller. Sheetan is on the line in Toronto. Hi, what's your question today?
Good afternoon, both of you. My question to Ryan is regarding the Canadian Bank. It had a very good run. Should I take a profit off the table or sit down and eat a dividend?
Sorry, which bank was it?
All the banks, whether it's a TD, Scotia, or BMO, all had a good run. I'm holding it. So should I hold it or take the profit off the table or
Got it. Okay,
continue collecting dividend?
Thank you for the question. So he's put his money in multiple banks. Where are you in financials these days?
Yeah, so we're underweight and have been for some time. That's not so much a market timing call. It's more of a structural call of we think there's better long-term places to put money. We still own a good chunk of Canadian banks, about 15%, but I think the market's sort of 20 to 25, right? So in terms of the banks as a whole, what we're doing with them right now is we're happy to sit on them if the client needs cash. So if you're in a position where you've got ongoing monthly expenses where you're needing to sell some of your portfolio, we don't mind selling some banks to fund expenses here. The yields have got down, for Royal, below 3%, below 4% for most of the banks other than Scotia. And so, at those levels, we think they're fairly rich, especially with what may be coming, which is, again, we are still not at the peak resets of Canadian home mortgages, which should come through sort of end of this year and into next year. So we're interested to see how they get through that. And we're also, we saw some flare-ups in the regional banking in the United States yesterday.
How concerned are you about some of those credit situations?
I think it's percolating. I think there would need to be a bigger event. So in 0809, you had the Lehman Brothers failure. And what that did was that triggered a chain reaction across a bunch of other banks to examine, hey, who owes who what here and how much of that am I going to get back? And people started calling things in. You would need that sort of event to start to unearth, I think, a bigger problem. And it's hard to say what would do that, right? We thought maybe Silicon Valley Bank a couple of years ago would do that, but then the Fed steps in and rescues everybody. So there's also the prospect of, central bank or government policy rescue as well. So it's a pretty hard thing to handicap. We just think, there's better places to put capital right now than the Canadian banks. And so we're happy holders, we're happy owners. We like to collect the dividends. If the client doesn't need the money, we're not selling anything, but we're not making purchases at these levels.
Okay. Let's move on to Gordon, who is on the line in Victoria. Hi, Gordon.
Good morning. Premium Brands has launched some new product programs. Impact expected end of Q3, full impact Q4. That's going to be offset to some degree by the closure of Starbucks stores in North America where they provide the breakfast sandwiches. What is your outlook for Premium Brands?
Okay, thank you for the question. Premium Brands, of course. Lots of different packaged goods. And we know that the public's moving a little bit away from processed foods, for example. So a company like this, what do you see?
Yeah, so they are, but they aren't, right? So there's definitely a move away, but there's still volumes are still growing. And so with Premium Brands, the caller pointed out the Starbucks issue. I would clarify that yes, Starbucks is closing stores, but they're also opening new stores. So it's more of a rejig than it is a shrink. But suffice to say, Starbucks is having problems and it's been causing problems for Premium Brands. We started to accumulate this company in March of this year, around the $80 level, and based on Rebecca's recommendation. And we haven't bought the other chunk of it. It's run away from us. So again, we're hoping for maybe more of a broader market pullback to pull it down, and maybe we'll buy the other half, or we might just have to buck up and pay, where it's at today. They are coming out with their quarter. I've seen some reports saying that the quarter could be a little bit messy. The big thing for them is they're ramping up with Costco in the United States. And so they had to invest it, like the capacity or the size of the prize with Costco is so large that they had to invest a lot in capacity. And then now they have to backfill that with orders. And that appears to be coming through, but it's going to be like LNG Canada, it's not going to happen all at once. So we like the setup for the company. We think it's well managed. It's again, another one of these companies that's really focused on the dividend. The management team really believes it. We like that. It's in an industry that is pretty defendable. It's food. It's not AI, chatbots, or microchips or anything like that. So, we like that stability and think it's got a good dividend yield. So we like it here. We'd like to buy it back sort of mid 80s, but I'm not sure if we'll get there.
Okay, 3.5% dividend, roughly?
Yeah, correct.
Okay, we're going to take a quick break. Back with more of your phone calls and your emails in a moment. Stay tuned. Welcome back. Let's go to the phone lines. Tim is holding on the line. He's in Alberta today. Hi, Tim.
Hi there. Good morning.
How are you?
Good. I'd like to ask the guest's opinion on TransAlta. And would he recommend any other companies in that sector?
Okay. Thank you for the question. So TransAlta still does coal and gas?
Mostly gas now. The coal has largely been retired, but it's gas power, so it's power generation, and that's why the stock has had a couple of rips here in 2025 as the enthusiasm about Alberta being a data center hub kind of has come and gone and come back again recently. And I think it will happen. The story on AI, and again, people would say maybe that I'm got my head in the sand on AI. No, I'm very interested in what's happening there. I just don't see the time frame where we can invest in it properly for our clients, because they're already valued like they're all going to win, and not all of them are going to win. But the power demand is real, and so any place where there's a surplus of energy, Alberta being one of them, Texas being another place that we like, Arizona as well, where there might be lower regulatory hurdles and able to get things built. There probably is going to be a project there. So where there's smoke, there is fire. TransAlta and Capital Power have been the two poster childs for that in Canada. There's been some in the United States as well, Constellation Energy especially. But we're not so interested in playing that shorter term binary. Is it going to happen? Is it not going to happen? Game. I have something in my top picks that is tangentially related, but has a bigger, more diversified business that we like better. So maybe the caller can stay tuned for that.
Okay, let's get to another phone call then. Claude on the line in Winnipeg. Hi, Claude.
Hi there.
Go ahead.
Yes, I was inquiring about National Bank. Do you think now they've had a year to digest Canadian Western Bank, do you think they're going to take over Laurentian Bank, and would that affect the dividends?
Okay, let's have a look here at the National Bank chart. It is up to 151.64, and it's done pretty well since that April low. Come back and then some.
Yeah, National's been a good performer. We don't own it. We kind of, again, we've got our bank holdings pretty entrenched in their long-term holds, and it's really tough for us to move one against the other on a short-term basis. So we kind of let them ebb and flow and go through what they go through. National's been doing a good job, though, so nothing bad to say about it. The caller talked about the CWB acquisition and then potentially taking a stab at Laurentian. I got to imagine there's a few people circling around Laurentian and then maybe some other financials as well, with the consolidations that have been allowed to happen, with RBC being able to buy HSBC and National being able to buy CWB. You would think that maybe some more consolidation is coming. However, Laurentian has been plagued with issues, and it's been kind of left out there so far. So we'll see, and never say never, but I wouldn't say it would just be National Bank. I think there would be a number of suitors if that were, or there will be a number of suitors if that comes to pass.
Okay, we hope that helps out, Claude. We'll go to Jim in Peace River. Hi, Jim.
Hi. I was wondering about Baytex. I was on the first half dozen pads that they drilled out there in Clearwater, and those wells, they're all doing great. What's it going to take for the Baytex share price to turn around? Thank you very much. I'll hang up and listen.
Yeah, it's interesting on Baytex. This is a company we owned a long time ago, and I've continued to follow it, and it's gone through a lot of turmoil. And I saw the other day that they're talking about selling their Eagle Ford assets, which is very interesting to me, because this is the problem with the company, is that it's split between two very different things: Canadian heavy and now some light oil in the Clearwater, as the caller points out, and some liquids rich, and then this Eagle Ford asset. And so they went to the Eagle Ford to try to get into the U.S. shale basin. They were kind of late. They got good assets, but they're non-operated. So they're kind of tugged along with, I think it's Marathon or Chevron. I can't remember who the principal is, but I don't follow it as closely as I used to. But I just sort of thought that was interesting that they're talking, or people are talking about them selling. I'm not sure if they're talking about it. It came out of a conference. So I think if that were to happen, that could be a catalyst for the company. And then you get people focused on the pure play Canada, which, as the caller points out, is doing well. But that used to be the thing that everybody wanted to shy away from. So it's kind of funny how, like I said, these Canadian oil stocks are actually seeing a bit of a renaissance in terms of investor appetite. I'm not sure how long it'll last. Used to be an energy specialist, have tried to see that football kicked a number of times to see it pulled away. So never, we'll see if it happens when it happens, but potentially that would be a catalyst you'd be looking for in the stock.
Okay, we are going to take a quick break. We have new top picks from Ryan when we come back. Stay tuned. Join us Monday for Market Call. Keith Richard on the show. He is President and Chief Portfolio Manager at Value Trend Wealth Management. He'll take your questions on technical analysis. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Ryan Bushell. We start with Algonquin Power, AQN on the TSX. You say it's been a painful few years for them. Do you want to backtrack and tell us what happened before we get to sort of why you like it moving forward?
Yeah, so previous management team maybe took the company too far, too fast, too many things. They were forced to kind of recalibrate the company. They sold most of their renewable assets, except for a very select few, and they endured 2 dividend cuts. But what's left is still a regulated utility company, especially now it's more of a pure play regulated utility company. Takes time to repair that confidence with investors, but it is trading at a pretty big discount to other utility peers with reason. But I think that can be closed over time. And then you have the upside that this is a smaller, more nimble company. It's almost 100% in the US. With the environment we see playing out there, we think there will be more opportunity for the company, either potentially as a takeout target, which would be our less favorite outcome, or just to grow organically and make some smart deals again. So the new management team we like. We see upgrades coming across the street, so it appears that the investment community is starting to finally warm up to the story. This was very much out in the cold. So we'll see what happens. But at these prices, with the dividend yield supporting it, I think you're pretty well protected on the downside and maybe have a little bit of asymmetric upside relative to other companies in the sector.
Okay. I'm interested in your next topic, which is Pembina Pipelines, because you mentioned ARC Resources, and they do the same thing. It's a natural gas play. Why do you like Pembina, and are you still invested in ARC?
Yeah, so they're complementary, actually. So ARC is more of a producer with some infrastructure, and Pembina is almost 100% an infrastructure company. So we think they're complementary. We own them both. We like them both quite a bit. There was a big run up in Pembina on the data center announcement. There was a report that Meta was inking a data center contract with Pembina. Pembina came out and said, yeah, we're working on something. We're not going to tell you basically exactly what it is. And then the news broke that KKR, which they have a joint venture with called Pembina Gas Infrastructure, was looking to sell their minority stake, which would be I think it's about $5 to $7 billion. So that would be great for Pembina in that it would surface the value of that they're not really getting. But the worry is that they're going to be the ones that buy it, and they're going to have to issue equity to buy it. So that's taking the stock back down. I don't really care. The point is, I think the company is really well set up, really well positioned. They've got Cedar LNG coming on kind of 2027-ish area. Again, the market doesn't care about that, but we do. We're longer term thinkers. Great amount of gas processing all throughout the basin that is going to be used in higher quantities as the LNG ramp gets going, and then also as more gas is demanded in other places in the northwestern U.S., other places on the continent. And there is potential upside with data centers and electricity generation from with gas that they are processing and transporting. So, I think the setup couldn't be much better for this company. I'm surprised it's languishing as it has for the last year or so, and continue to buy it at a full weight in all of our accounts.
Okay, let's get to your next topic, which is Cabot Linen, which we did touch on a little bit earlier in the day. KBL on the TSX, and this is a company that does something we don't normally think about very much, which is laundry for hotels, hospitals. How big is their reach?
Yeah, so primarily hospitals, and it's primarily Canada and then the UK. So they just did a big acquisition in the UK earlier this year. I mentioned that. They beat out a private equity player that was potentially maybe more short-term focused, and it was quite they were the underdog in that fight, and came out on top. I love this management team. I think that they're very solid. They're not flashy. They just care about the work. In a world where, if you look at these 3 topics I'm bringing you today, I'm pretty worried about market valuations generally. I'm trying to bring things to people's attention that won't hurt them and should perform over long periods of time. These are not one-year picks. These are, we try to have forever picks or at least decade picks. I think all 3 of these companies are in a position where you can buy them today. If the market goes down significantly, you're not going to get hurt in them. You're going to collect that dividend yield. And Cabro is, as you mentioned, a very stable business. It's primarily hospital now. There is some hospitality more so in the UK, which is consistent business, but it does float more up and down with the economy, whereas hospital is, in our view,
kind of guaranteed.
Guaranteed and probably guaranteed to increase slightly just with demographics and healthcare needs. So, and there's more hospitals, there's budget cuts that require them to have, potentially outsource internal laundry, make themselves more efficient and outsource some of their laundry operations that some of them do internally. So, I just think that this is a really consistent company with good management and a 3+% dividend yield that you can count on.
Why do you think that they won the contract in the UK over the other players?
I'd have to remember the call exactly. We talked about this in detail, and I believe, and I hope Linda won't hold me to this, but that basically they were just better integrated with the assets that the company, the sellers basically chose them because they were the better
They
player.
were already in the UK operating?
Yes, they're in the UK already, and this is a complementary asset for them. That again, when you go up against private equity, they tend to sometimes want to pay a higher price in the interim just to get the capital deployed, depending on the private equity fund and what's going on with it. So it was a bit of a coup for them to win this asset as a public player with capital discipline.
And did they get a boost from that acquisition?
It's not happened yet, right? It's still new. They're still integrating the asset. I don't even know if it's fully closed yet. But you're looking at going forward. You should see, if things play out as they expect, if they're able to get the synergies out of it that they expect, it should be a nice kicker on their annual growth rate.
All right, something to watch for. Okay, we do have to leave it there. Ryan, thanks for coming in.
Thanks for having me.
And thank you for joining us today on a market call. We'll see you again on Monday.